Mobileye built this entire industry. Before NVIDIA, before Qualcomm, before any of them. Its technology is inside 230 million vehicles on the road right now. It works with more than 50 automakers across roughly 1,400 car models. It shipped 35.6 million chips last year alone. And the stock is down 85% from its peak, trading at its lowest price since it went public. Mobileye scored a 6.1 out of 10. The verdict is watch list. Cheap enough to monitor, not yet proven enough to own. So why is the market treating this company like it's dying? And is the market right? Let's break it down. Mobileye designs the chips and software that let cars see the road and react to it. If your car can brake automatically when someone steps in front of you, or keep you centered in your lane, or drive hands-free on the highway, there's a good chance Mobileye's technology is making that happen. They have been doing this since 1999. They are the company that essentially built the ADS industry. ADS stands for Advanced Driver Assistance Systems. That is the umbrella term for all those safety and convenience features that help a car drive itself to varying degrees. Last year, Mobileye generated $1.89 billion in revenue. They produced $523 million in free cash flow, meaning that is real cash in the door after paying every bill. And they did it all with zero debt. That is a healthy business by any measure. So what is the problem? Here's where it gets complicated. Revenue roughly doubled between 2020 and 2023, going from about $967 million to $2.08 billion. Then, in 2024, it dropped 20% because the car companies that buy Mobileye's chips had ordered too many the year before and needed to work through their stockpiles. That is called an inventory correction, and it is a normal cycle in the semiconductor industry. Revenue bounced back 15% in 2025, but it still has not returned to that 2023 peak. And the guidance for 2026 is flat to 5% growth. Management has called this year a transition year. For anyone watching this stock, that translates to do not expect much until 2027. But here's the number that should stop you. While Mobileye's revenue went sideways for 3 years, the overall market for ADAS chips grew at double-digit rates. The market got bigger. Mobileye did not grow with it. That gap tells you the company is losing market share at the total market level, and that is the single most important thing to understand about the competitive picture. So where is the share going? Mostly to 3 places. NVIDIA is the biggest threat. Its automotive revenue hit $567 million in a single quarter, up 72% year over year, and the company is targeting about $5 billion for the full year. NVIDIA's latest chip, called Thor, delivers 2,000 TOPS of compute power. TOPS stands for trillions of operations per second, and it is the standard measure of how much processing a chip can do. Mobileye's newest chip, the IQ6 High, delivers about 34 TOPS. That is not a small gap. That is nearly 60 times less computing power. Now, Mobileye will argue that raw compute is not everything, that their software is more efficient and their system costs less. And that is a fair point for today's basic safety features. But as cars move toward higher levels of self-driving, the demand for compute power goes up dramatically. And that is where NVIDIA has an enormous advantage. Then there is China. A company called Horizon Robotics has captured 45.8% of the domestic ADAS market among Chinese automakers. Mobileye's share in China dropped 8.7 percentage points in just 10 months. China represents about 23% of Mobileye's revenue, roughly $428 million. So this is not a small market to be losing ground in. And then there are the automakers building their own chips. Tesla, XPeng, and NIO have all developed proprietary silicon. Every vehicle those companies sell is a customer Mobileye can never win. So the bear case writes itself. Revenue is stalled. The competition is getting stronger. China is slipping away. Why would anyone look at this stock? Because of the price. And this is where the whole story turns. Mobileye trades at an EV/FCF multiple of 9.5 times. EV/FCF compares the total price tag on a business, including its cash and debt, to the free cash flow it generates. Lower is cheaper. For example, at 9.5 times, if you bought this entire business, the cash it produces would pay you back in under 10 years. Most semiconductor companies would take 15 to 25 years. That is a low price tag. The free cash flow yield is 8.4%. That is a ratio that tells you whether a stock is cheap or expensive relative to the cash the business actually produces. A high number means the stock is cheap for the amount of cash it generates. At 8.4%, Mobileye is firmly in cheap territory. But a yield that high also means the market sees something potentially wrong. The whole question is whether the market is right or overreacting. But here's the part that really stands out. Mobileye has a $24.5 billion design win pipeline over 8 years. A design win pipeline means contracts where automakers have already committed to using Mobileye's chips in future vehicle programs. These are not vague intentions. These are engineering commitments that take 3 to 5 years to reach production. The pipeline includes programs with Volkswagen Group, Mahindra, a major undisclosed US automaker, and others. It grew 42% from the end of 2022 to the end of 2025. And the market is assigning zero value to it. A sum of the parts analysis, which means valuing each business segment separately and adding them up, shows that at $7.37 per share, you are paying only for the mature base ADAS business. The advanced products, supervision, chauffeur, the autonomous driving programs, Mentee Robotics, none of it is reflected in the stock price. The market is treating the entire growth engine as if it does not exist. That is either the market being smart or the market being too pessimistic. The analysis says it is probably too pessimistic, but with a major caveat. Here is the caveat. Mobileye spends $1.15 billion a year on research and development. That is 61% of revenue. To put that in context, the base ADAS business, the stuff that generates almost all the revenue today, only needs about $350 million to maintain. The other $800 million is being invested in those advanced products that the market values at zero. If you strip out that growth spending and look at the base business alone, it would generate roughly $980 million in adjusted operating income, which is what the business earns from its core operations before accounting noise. At the current price, that means the base business alone trades at about 5 times its earning power. That is extraordinarily cheap for a semiconductor franchise with 230 million vehicles on the road. The market is essentially saying, we think that $800 million in growth spending is wasted. And honestly, that is hard to believe when there is a $24.5 billion pipeline backed by named customers. If even a fraction of that pipeline starts converting into real revenue, the market has to reprice this stock. That is the catalyst. But the concerns do not stop at competition. The CEO is Professor Amnon Shashua. His credentials are exceptional. 27 years leading this company, over 200 patents in computer vision, recognized on the Time 100 AI list. He owns about 7.3% of the company's shares, worth roughly $131 million at today's price. And he has bought stock on the open market at $16.51, more than double where it trades now. That is genuine skin in the game. The problem is what he did with company cash. In February 2026, Mobileye spent $900 million to acquire a company called Mentee Robotics. Mentee is a humanoid robotics startup. It has no revenue, no proven product, no clear timeline to profitability. And here's the part that matters most. Shashua co-founded Mentee and chaired it. He personally received approximately $341 million from the deal. The CTO received another $118 million. That is $459 million in combined proceeds to 2 sitting executives from a transaction between Mobileye and a company its own CEO started. Shashua recused himself from the board vote. Intel, which owns about 80% of Mobileye, approved the deal. But the optics are difficult, and it gets worse. Shashua also simultaneously chairs Orcam, AI21 Labs, 10 Digital Bank, and co-founded another company called AAI Technologies, on top of holding an active academic position. This is a CEO running the most critical technology transition in Mobileye's history, while splitting his attention across at least 5 other ventures. For investors considering a position, the governance question is real. Is management fully aligned with shareholders, or are there competing interests? And then there is Intel. Intel owns approximately 80% of Mobileye's outstanding shares, with a dual-class structure that gives it roughly 99% of voting power. No shareholder vote at Mobileye reflects independent sentiment. Intel has been a net seller of shares and is dealing with its own financial difficulties. If Intel needs cash and decides to sell a large block at a discount, Mobileye's stock price takes the hit, regardless of how the underlying business performs. That pressure on the stock does not go away easily. If Intel holds, the threat of a future sale looms. If Intel sells, the shares hit the market and push the price down. Either way, it weighs on the stock. So where does this all land? The analysis identified 5 conditions that must hold for this investment to work. If any one fails, you have to reassess. First, advanced ADAS design wins must start converting to production revenue by the third quarter of 2027. Supervision volumes need to reach at least 150,000 units annually by that year. Second, total revenue must exceed the 2023 peak of $2.08 billion by 2027. Third, the average selling price per chip must stay above $48. 2 consecutive quarters below $45 signals the product mix is degrading, not improving. Fourth, the company cannot lose more than one committed OEM partner to a competitor like NVIDIA, Qualcomm, or Horizon Robotics. 1 is a setback. 2 breaks the thesis. And this is not hypothetical. Zeekr has already been flagged as a potential defection, and Volkswagen is simultaneously partnering with Horizon Robotics. And fifth, the cash balance has to hold up. After the Mentee acquisition, the company has about $1.2 billion in cash. That sounds like a lot, but this is a business that spends over $1 billion a year on R&D. One bad year and that cushion shrinks fast. If cash drops low enough, the company has 3 options, and none of them are good. Cut the R&D that funds the growth story, take on debt for the first time, or issue new shares that dilute existing investors. 2 more things to keep an eye on. Any changes to the $24.5 billion pipeline number, up or down, and Intel's stake activity. Any large block sale hits the stock price, regardless of how the business is performing. The trade report will be tracking these and sharing updates across social media as they develop. The scenarios break down like this. Bull case, $14 to $18 per share, roughly 90 to 144% upside. That requires supervision to accelerate, Chauffeur to enter production with VW Group by 2027, and the market to re-rate Mobileye from a declining supplier to a physical AI platform. Base case, $10 to $12 per share, roughly 36 to 63% upside. FY 2026 revenue at guidance, FY 2027 at 10 to 15% growth, margins stabilizing. Bear case, $4 to $5 per share, roughly 32 to 46% downside. That assumes the economy weakens or one or more of the conditions above start breaking down. Downside is anchored by $1.2 billion in cash on the balance sheet and a business still generating hundreds of millions a year in free cash flow. Upside only requires that the market assign any value at all to the advanced pipeline. The verdict is watch list. The analysis says this stock becomes a buy below $6, or upon confirmation that supervision volumes are tracking above 100,000 units annualized, whichever comes first. Until one of those triggers hits, the right move is to monitor, not own. The valuation compensates for the risk, but the proof has to show up in the numbers first. If you know something about this company that did not make the analysis, I want to hear it. Comment below. And drop the next company you want analyzed. Like and subscribe so you do not miss future videos. This is for educational and entertainment purposes only.